Hello everyone, and welcome back to another video. So in this video, we're going to be talking about fundamental and technical analysis. So fundamental and technical analysis are two of the most commonly used ways to analyze stocks and their trends. And using fundamental and technical analysis, we will analyze stocks and companies and then figure out whether or not it's a good idea to buy or sell the stock. So let's get started. I'd like to first talk about fundamental analysis. So fundamental analysis is the practice of holistically looking at the different parts that govern a company and subsequently looking at the finances of the company in order to get a really good understanding of what exactly is going on within the company. And then once you have that understanding, you can base your investment decision. So it involves the usage of mathematical strategies that delve into different parts of the company. And the end goal of fundamental analysis is to find the intrinsic value or the stock's real value. In addition, another end goal of fundamental analysis is to gain a solid understanding of the company such that you can just think about it and make predictions regarding the company based on your current understanding. So let's get started with fundamental analysis a little bit. So there's some key things that an investor would be looking for when he or she is conducting fundamental analysis, and several of these things include branding image. Is there good public perception about the company? Brand recognition. Do people recognize the company and its products? Is the company a leader in its marketplace? Essentially, good management and CEO. Is the company properly managed? Are there acceptable levels of debt? Is everything okay financially? And finally, future growth potential. Is there any way for the company to improve, or is there any way for the company to grow such that it can make more money in the future? So these are all things that you're going to be looking for. And once you understand what's really going on, it's pretty intuitive and it's pretty easy to, in fact, to make a decision regarding the company. For example, if a company does not have a lot of future growth potential, it doesn't really make sense to invest within that company because at best, you'd make little to no money because the stock and the company would remain stagnant. At worst, it's possible that the growth actually turns negative and the company starts to contract or shrink in value. And as a result, uh, your stock and the company is going to be worth less. So you're going to be having a losing investment. So it's important to think like that and just to analyze the different components so that you can make conclusions about it. And now I'd like to talk about intrinsic value. So remember how I said that the ultimate end goal of fundamental analysis is to find the intrinsic value of the company. I'll go back to that slide. So yeah, right here. The end goal is to find the intrinsic value or the stock's real value. So what is this intrinsic value? So remember how I said that there are many different metrics or many different financial things in essence that are going on within the company. And there are many different ways of understanding the finances of a company. We can look at the level of profitability. We can look at at their earnings. We can look at their earnings per share. We can look at debt. We can see how much debt they have. We can see how equity and profitability, revenue growth, how all of that is changing over time. We can see how they're adding or subtracting new debt. There are a lot of ways of basically understanding the financial position of a company. What intrinsic value does is it basically looks at all of these different things, all of these different aspects or attributes that govern the finances of a company. And then from there, we extract a singular numeric value that represents the ideal price or the real price of one share or one stock within that company. The intrinsic value is the real price of the stock based on the financial processes that are going on within the company. So here's the thing, why do we find intrinsic value? We find intrinsic value to see what the company is really worth on a share by share basis. And then we compare that to the market value or the market price. And then we see whether or not the stock is overvalued or undervalued. Now, what is overvalued? Overvalued means the market price is higher than the actual price. You're basically paying more for an asset than what it really is worth. Undervalue is the opposite. The market price is less than the intrinsic value. So you're paying less for an asset than what it's really worth. And why are we concerned with over and undervaluation? Well, number one, we have a good estimate with over and undervaluation and intrinsic value. You have a good estimate or a good understanding of how much you're paying for a particular asset. But more importantly, it's good to understand when overvaluation and undervaluation can be both a positive and negative thing. So it's commonly in uh, something you might commonly hear is that an overvalued asset is not good. And at first, that may seem sensible. You can think to yourself, and you'd note that if you're paying more for something than it's really worth, is that really a good deal? For example, if a car is worth $10,000 and you realize that someone's selling it to you for $15,000, is it really worth to buy that car at that price of $15,000? So it's basically the same for stocks. If on the market price, the stock is worth something, and that market price is higher than the intrinsic value, is it worth to buy that stock when it's overvalued? And here's the answer to that question. It's both yes and no. Here's the thing about overvaluation. Overvaluation happens because there is a lot of interest in the stock. So there's a fixed amount of shares or total stock in any market. And according to the laws of supply and demand, if more people start to buy the stock or there's more demand for the stock while presuming a fixed supply, the share price or the stock price would go up. And as a result, if this happens enough, a stock can become overvalued. But the stock can, let's say the stock is overvalued, but it can continue to grow because you did fundamental analysis and you realize that the company's finances are doing great and the company can continue to grow and overall it's just a healthy company. Well, in that case, the company is overvalued, but it could still be a good investment because if you were to buy it, you realize that the company as a whole is going to be growing and all of a sudden uh, your investment is worth more. That is an example of when overvaluation is not necessarily a bad thing, but overvaluation can also be a bad thing. Let's say a lot of people buy into a stock because they feel optimistic about it. They think that for whatever reason, the stock will continue to grow in the future. And then as a result, the market price is much higher than the intrinsic value. But here's the thing, let's say that for whatever reason, the investors were wrong. They realized that the company no longer has that growth potential, or they realized that the company no longer is just worth that price that they've pushed it up to. As a result, it's only intuitive that these investors would lose confidence in their investment and sell. As a result, an overvalued stock suddenly came crashing down. So that is an example where overvaluation can be bad. So overvaluation gives you a metric of how much a company is worth and whether or not you're paying the right price for it. But the key thing to realize about overvaluation is that although some people may say it's always a bad thing, you should never buy an overvalued stock, it's not necessarily true. Overvaluation is not always a bad thing unless there is still some growth potential. It does become a bad thing if there is no longer enough growth potential because all of a sudden people realize that you have an asset that is worth on the market way more than it's really worth, or the asset's price is more than it actually is worth, and that the asset can no longer grow. So why bother paying for that asset, or why bother buying that asset even more? That would motivate investors to sell. So that is an example where overvaluation is bad. So this is the key thing or the key takeaway from the intrinsic value. You figure out whether or not you figure out the real price of a company and you see whether or not a company is overvalued. You can or undervalued for that matter. But once you understand whether or not it's over or undervalued, you have to use it in conjunction with other metrics such as growth potential or brand image or management, such as the CEOs, some of the things I talked about in the previous slide. But you have to use intrinsic value in conjunction with those metrics to truly gauge the nature of your investment. So the same thing can happen to an undervalued stock. It's totally possible that the undervalued stock, at first glance, it might seem like a good deal. You have something that is trading for less than it's actually worth. But you have to think to yourself, can this stock or can this asset continue to grow? If it can't continue to grow, even if it's undervalued, why on earth would it be a good investment? if the converse is true, such that the stock is undervalued, but it can also grow, then that's a gold mine right there because that is the optimal situation you're looking for. You're essentially going to be buying something that at a lower price than you should be buying it at, or you're buying it at a lower price than it's worth. And then because it has growth potential, it's totally plausible that that company can go up. So here's the thing, with intrinsic value, you can figure out whether or not a company is over or undervalued, but simply looking at whether or not a company is over or undervalued isn't the only thing that you should be thinking about when buying the stock. Instead, you should be thinking, can this stock continue to grow? And as a result, overvaluation or undervaluation will make sense. And you can think to yourself and you can conclude whether or not it's worth paying an over or undervalued price. So, just to sum everything up, fundamental analysis consists of uh, looking at the different components, the different sectors within a company, and then understanding the financial health of the company so that you have a good understanding of the intricacies that govern that company along with future growth potential. Afterwards, you can calculate the intrinsic value to see whether or not your investment on the open market into that particular stock is going to be over or undervalued. And like I said before, overvaluation, undervaluation shouldn't necessarily be the only things you should be looking at. You have to use those in conjunction with growth potential to truly understand the nature of your investment. Thank you for listening, and I hope you learned a lot.